Hey, you guys, we are going to do a quick review of revenues and receivables, their relationship, and then specifically net revenues and net receivables and what those contra accounts are to get us from that gross to net. So let me switch over to my document camera and uh, grab that. Okay, there we go. So quick reminder, accounts receivable is an asset, therefore it should show up on which financial statement? The balance sheet. And sales revenue is no trick there. It says revenue, it's a revenue account, so it's reported on the income statement. So keep your dealer chart out. We learn about so many new kinds of accounts in intermediate, and it's hard to just memorize this weirdo new account without having any context. So if you know which one of these 6 categories it is and which financial statement it goes on, it's going to help you understand it, which ultimately is how you remember it and how to use it, right? So we know that AR and sales revenue go up when a company makes a sale. So revenue would go up with a credit because it's on the right side, and AR would go up with a debit because that asset is on the left side. But what happens if a customer returns an item or the company gives a discount for something? Then their revenue would need to come back down, right? Which would mean a debit to the revenue account. Well, in Principles of Financial Accounting, we talked about how companies like to, instead of debiting the revenue account directly, debit a contra revenue account, which still has the same effect. It makes revenue come back down, but it gives them these accounts that helps them analyze better how many returns are we getting, how much are we giving in sales discounts, things like that. So there are 4 things we talked about in Principles of Financial Accounting that reduce a company's revenue. So I'm not talking about expenses here, cost of doing business. I'm talking about revenue went up and then it came back down because a customer returned something or whatever. So the first one is a trade discount. This is really like a quantity discount. A company says, hey, customer, if you buy 100 of these, here's your price. But if you buy 500 of these, I'm going to give you a discount. And if you buy 1,000 of them, I'm going to give you an even bigger discount. Then we talked about sales discounts. This you learn in intermediate that we can also call these cash discounts. And this is given to entice customers to pay faster than they have to. So, an example, I'm going to write this down, and you should remember from principles that this means, sorry, I can't make stuff up and talk at the same time. 315 in 45. What does that mean? It means that we sold some stuff to a customer on account and we've told them, look, you've got 45 days to pay us back. But if you pay us back in 15 days, we will give you a 3% discount. So that is enticing that customer to pay us back faster than the 45 days. But if not, then the net amount of it's just due in the regular 45 days. Okay. Then we learned about sales allowances. Sales allowances are given for various reasons, but it could be because a customer wasn't happy with the product or the service provided, so we give them a discount. And then finally, we learned about sales returns. Y'all all know what that is. You've taken something back to Target or Walmart before. That's, again, the company recorded revenue. It went up when they sold it. It needs to come back down when the customer returns it. So here's our quick little example. Snap Crackle Pop is a chiropractic facility. They normally charge $120 for a spinal adjustment. Currently, they're offering a $20 discount. That's a trade discount to entice senior citizens to come in. In addition, they offer these terms. Remember, this is our sales discount here, cash discount to customers of a 2% discount if they pay back in 10 days. If not, the net's due in 30. So stop for just a second and see if you can remember. This trade discount acts differently from these 3. These 3 are the contra revenue accounts you learned in Principles of Financial Accounting. Trade discounts, we don't record a gross and then back it back out. We just record it at whatever the discount price is. So let's look at our transactions. On June 18th, David is 72. He calls to set up an appointment. What kind of entry does Snap Crackle Pop need to make? Nothing. They didn't get any revenue. They didn't get any cash on deposit. So no journal entry is needed here. Okay, on June 20th, David visits Snap Crackle Pop and receives his spinal adjustment for the discounted price on account. Don't forget, pay attention when you see on account. No cash. Okay, so on June 20th, what would Snap Crackle Pop record? If they didn't get cash, if they sold it on account, then they're going to record an accounts receivable, which is an asset increasing, at how much, y'all? 120 or 100? They go ahead and record it at the discounted price. And then the credit is to sales revenue. That's the revenue going up at 100. See, I don't have an account called trade discount. Oh my gosh, y'all couldn't even see that. There we go. I don't have an account here called trade discount. That's it. I just record it at that. So sold services on account would be my description. Okay, now on June 20th, David also purchases a special pillow for his back for $40 cash. What would the company record for the sale of the pillow? Well, this time it is for cash. So there's my cash. My credit is sales revenue. For purposes of this little reminder, I am skipping the perpetual inventory method, but we'll get into that in this chapter in class. We would also go ahead and record the cost of that pillow. I don't know what it is. This problem doesn't tell us. And we would remove it from inventory at this time. But again, for purposes of this little review, I'm kind of just ignoring that right now. Okay, now we get to June 21st, and David wants to return this pillow, y'all. Notice how the revenue went up here when he bought it. So we need that revenue to come back down now that he's returning. What will he record? Well, to make revenue go down, I need a debit, but instead of debiting the revenue account directly, I use that contra revenue called sales return. We'll call that a contra revenue. And so that's going to make my revenue go down by that 40 bucks. What would they credit right here? Well, in this example, because he paid with cash, then they're going to give him cash back. You've got to be careful and watch that though. If he had bought this on account, they would not credit they would not credit cash, they would credit accounts receivables. But he paid cash, so we're going to give him his cash back. Customer returned item, whatever you want to write for your description there. Okay, now finally we get to June 29th. David pays for his office visit. Now when you see those words pays, paid, paying, now you know we're going to record some cash, right? If David is paying, that means Snap Crackle Pop is receiving the cash. Snap Crackle Pop, their cash is going to go up. Our question is, by how much? How much does David owe Snap Crackle Pop? Well, in this example, he owes them the $100, but remember, there was that other discount. They offered these terms of 210 net 30. Did David pay within the discount window? Yeah, he got the adjustment on the 20th and he paid within 10 days. It's just now June 29th. How much of a discount is David going to get, you guys? How much in cash? Well, it's just $100, what he owed them, times the 2%. So you just got to remember that formatting there. And that's just $2, right? Woohoo, we got a $2 discount. So how much cash is he going to give us at Snap Crackle Pop? $98, 100 minus the $2 discount. Okay, so there's their cash they got. What's the rest of this journal entry? What else do they need to do? Are they going to record sales revenue again or service revenue? Sorry, you know what? I should have put service revenue up there because they provided a service, not selling an item there. Okay, no, they're not earning more revenue in this situation. They are just getting paid back what he owed them on account. So their AR needs to go down now to show David no longer owes this. What does their AR need to go down by? So I want to show it to you in the T account because I want you guys to get used to making T accounts. It's going to make your life so much easier. Their accounts receivables went up by $100 when David got that adjustment. They have told him, David, if you give us $98, we'll call it even. You're not going to owe us anything. But look, if they record $98 in their accounts receivable, what balance is that going to leave? It would leave a $2 balance forever that David does not owe. So what amount do they have to reduce their AR by? It's got to be by $100. They have to make it go down by 100 in order to get a zero balance in AR. I know y'all all know that and can see that, but it's just a common mistake students make. So it's easier to look at it in T accounts. Use your T accounts. They'll save your life. Okay, that means I made a boo-boo up here. I didn't leave space for me to do another debit. Remember, we always want all of our debits to go first and then all of our credits to go next. That's why you should use a pencil, not a pen. But I'm going to need a debit for $2 to make this journal entry balance, because then that'll give me 100 for my debits and 100 for my credits. What is that $2 debit going to go to? That is going to be to the sales discount account. Remember, that is also a contra revenue, contra revenue for $2. Okay, let's stop and make sense of this and see how you're going to report this on your financial statements and what all my T accounts look like. My AR went up by $100 and I didn't make me a revenue account. I'll put all my revenue in one T account over here. My revenue went up by $100. All right. Then in number 2, our cash went up by $40. And once again, our revenue went up by $40. Up and up. Spinal adjustment pillow. All right. Then in number 3, our cash goes down by 40. Not really concerned with cash here. And our sales return has a debit of $40. Okay, there's my debit of $40 for that. Then in number 4, our cash goes up by $98 and our accounts receivable goes down by 100. We've done that. We see our zero balance there. And also we had a sales discount of $2 that was a debit. Okay, what does that look like on your financial statement? That is what we are so concerned with in intermediate, because this is what users, stakeholders look at and decide if they want to invest in our company, or if you're a financial analyst, recommend the sale of stock of this company. We've got to make sure we get this presentation right so that we're being honest, showing relevance, representational faithfulness, all of those characteristics that we've learned about that customers, not customers, excuse me, stakeholders really need to pay attention to. So obviously, first off, you need to remember that net revenue goes on the income statement. I'm not going to do a full heading here, but you know that income statement needs to have the company's name, and it doesn't need to have just one date. It needs to show the whole period. Often we'll look at a whole year at a time, but it could be quarterly, monthly, whatever, the whole period. Okay, so gross revenue is how much? It's $140, right? Here's 140. Then these contra revenue accounts reduce it. So I'm going to say minus sales returns of $40 and minus sales discounts of $2. What's this sales allowance? We didn't use it in this example, but if David wasn't happy with his back adjustment, he might say, hey, I think y'all did a bad job. Well, they can't return it, right? So they might say, okay, we'll give you a 10% discount or something. And sales allowances would show up here as well. We just don't happen to have any in this problem. So 140 minus 40 minus 2 is 98. What do I call this $98? This is net revenue. So I want you to stop and really focus on something for a second. It's easy to go, yeah, that makes sense. But when you go do it by yourself, you're like, oh, wait, what? Net revenue is different than net income. How so? Well, look, we've got to add a whole bunch of expenses in here. So all 3 of these things do reduce our revenue, but they are not expenses. What do we call those things? contra revenues. So if we report them on the financial statement, they are going to go up with the revenues to get us down to net revenue. Then come expenses, then comes net income. So in practice, what we'll see a lot as we look at real companies in intermediate is that a lot of times companies start right here with net revenue. But trust me, they've kept track of it up here because, like I said, management wants to analyze how much did we allow in returns? How much did we give in sales discounts and sales allowances? That kind of thing. But in practice, in real life, you might see it start with net revenue. And then another thing I wanted to point out is that sales returns and sales allowances are often called SR and A. So if you see that on a financial statement, you're going to see SR and A sometimes, and that's what that means. Okay, got it? That's the revenue piece. Let's move on and do everybody's favorite allowance for doubtful accounts. So now we're going to flip over and focus more on the balance sheet rather than the income statement. I'm going to dive right into a problem. Community medical is an outpatient health facility that provides health-related services to the community. Many of the patients don't have health insurance. And so at the beginning of 2025, their allowance for uncollectible, or I also call it allowance for doubtful accounts, was a $100,000 credit. Stop. What type of account is that? I'm going to go ahead and post that right there. What is this account? It is a contra what? Contra asset. Remember, contra accounts always have to have a buddy. Its buddy is AR, which is an asset. Therefore, it's a contra asset. Whereas, oh, sorry, word got stuck. Whereas when we learned about these accounts, their buddy is sales revenue. See how it got posted on the income statement? So they are contra revenue accounts. Whatever they reduce, it's a contra that. All right, so over here, back to our contra asset. This allowance for uncollectible accounts is when a company has to estimate, GAAP says so, hey, we think we're not going to get this much back, and it's kind of a rolling balance. Every year they analyze it and go, how much do we think this year customers aren't going to pay? So in principles of financial accounting, we looked at just kind of the balance sheet method. We're going to base it off of AR. We'll learn another method in intermediate. So this is just a reminder of what you did in principles. So that was at the beginning of 2025. So I'm going to say January 1st, 25. Then during the year, forgot to change that. That should say 2025. During the year, they actually wrote off $120,000 of AR during the year. What would happen? Do you remember how to do that actual AR write-off? Well, this is when we know, aha, I know which customer it is that isn't going to pay us back. Therefore, I can identify which AR account needs to be written off. So I can for sure make that AR account go down by 120 grand. And therefore, I remove that amount from what I call the estimate pool, the allowance for doubtful accounts, ADA. Remember, that's a contra asset. Okay, let me go ahead and post these two. We'll recap this at the end and y'all will remember. It'll get better. My ADA, I'm going to post $120,000 debit. This is during 2025. And my AR comes down by 120,000. Now it's the end of 2025 and it's time to estimate again future uncollectible accounts. Well, it tells us our gross AR balance at the end of the year was $850,000. So we can just say a percentage of that, or we can kind of break it up into aging. So it makes sense that the longer a bill is outstanding, the less likely you are to collect on that, right? So they said for these first bills, 600,000, 10% likelihood or 10% of these that we're not going to get paid on. So that'd be about 60,000 bucks. And then for 1 to 45 days past due, we're going to say just 20%, 200,000 times 20%, that'd be $40,000. And then more than 45 days past due, man, I bet 60% of those people aren't going to pay, or 60% of that amount. So 50,000 times 60% is $30,000. So ultimately, I think $130,000 is going to be uncollectible. Okay, make sure you've got that. And now we need to move on and figure out what we're going to have to estimate of this amount, what journal entry we're going to need to get us to this amount. So let's come back down here and look at our T accounts. Remember, this 120 of AR was written off during 2025. Well, then it jumps and just tells us, hey, but at the end of the year, we ended up with 850 end of year. I don't know what else happened there, right? The problem's not telling us. So don't let that confuse you. How did we get from 120 to 850? I don't know. We sold a bunch more services on accounts, right? Okay. Now I'm going to jump to my ADA account. You can call this allowance for doubtful or allowance for uncollectible accounts. It was a $100,000 credit at the beginning of the year. Then during 2025, we wrote off another $120,000. So I call this removing it from the estimate pool because, aha, I know whose account I wrote off. And what is my balance here before we make a new journal entry? My balance would be a $20,000 debit. But what do I want the balance in this account to be? I want it to be 130,000. That's how much I think is going to be uncollectible of this 850. Y'all, this is what I want to show up on my balance sheet. I want 850 to show up here as the gross. I want 130 to say, I think I'm not going to collect this. How do I make this number happen? If I had 20 as a debit, how do I get to 130? One of the most common wrong answers I get when I do this in class for principals is 110,000. Okay, y'all know how to do T accounts. What's 110 minus 20? Uh-oh, that would be 90. So it can't be 110. It's going to have to be whatever minus 20 gets you to 130. Oh, that's 150,000. So I need a journal entry of 150,000 this year to let me ending balance needed, to let me end with what I really think I'm not going to collect. 150 minus 20 is 130. Here's the journal entry I need to make. Why did that happen? Why did if I really only expect to not receive 130, why I gotta make a journal entry for 150? Well, it's because last year we obviously didn't guess high enough, right? We had $100,000 balance in there, but we ended up writing off $120,000 worth. And remember, we don't go backwards and change our financial statements. Those have been audited, stamped, and released to the public. So we can only correct it going forward. So since last year we guessed 20 too little, this year we have to up it by 20 too much. So that's what I mean when I say it's always a rolling balance. So what is the actual journal entry for that adjustment? Well, it's the 150, and you can see right here that that's a credit, ADA, credit for 150. What's my debit? Can y'all remember? It's that bad debt expense that we record on our income statement. This is on the balance sheet. That's on the income statement. So a picture of our balance sheet here. Remember, we report only ending balances. There's our ending balance of 850 in the AR minus our ending balance of 130 in the allowance for doubtful accounts gets us to, don't forget this term you learned last year, net receivable value. Or you can think of it as it's our net AR. This is our gross. People really owe us this. But net, we think we're really only going to get this. So I think I said receivable, net realizable value. Let me write that down just in case I said that. Realizable value. So that goes on your balance sheet. So if on an exam, I'm asking you, hey, calculate net revenue, calculate net realizable value, calculate net income. Don't let all those nets throw you off. The word net in accounting just means it's been reduced by something. So it means this is going to be smaller than the gross accounts receivable. Net income is going to be smaller than gross income. Net revenue is going to be smaller than gross revenue. That's all that means. Um, one more quick thing about this. So the direct write-off method. Some companies can use the direct write-off method, and this is a lot easier. You don't have to estimate how much you think customers aren't going to pay you. You just wait until, in the case of a hospital, a patient dies or they've claimed bankruptcy or something, and you go, oh, I guess they're not going to pay us. We'll write it off now. Theoretically, GAAP might let you do a direct write-off method, but in practice, it doesn't happen. They only let you if that would mirror exactly what the estimated would be. So really, we always have to estimate. Then when you get to tax class, we learn, you can only write it off for tax purposes using the direct write-off. So you kind of switch your brain from financial accounting to tax accounting. So I want you to think about this, not just memorize where accounts go, but why is this important? How could a company and why might they manipulate their earnings by either, remember, accountants don't come up with this, management comes up with this estimated amount that they think they're not going to collect. And what is this based on? Well, it's based on what is our credit policy? Who do we give credit to? It's based on general economy. If we're in a recession, more people aren't going to be able to pay their bills, things like that. So why might a company go, hey, I think we're not going to be able to collect 130, but let's don't record that this year. Let's really record it at only 100. What would that do? Well, that's going to make their assets look better, higher than they should be. And it's going to make their revenues on the income statement look better, right? If I make this bad debt expense go down, the less expenses I have, the more revenues I have. So if you're a manager or an executive that gets bonused on net income, higher you can get that net income, the more bonus you get. So there's your incentive to manipulate that. Why would you manipulate it the other direction? Say I really think this balance here should be 130. Why might I record it at 140? Well, maybe you've already had a pretty good year and you're reaching your earnings targets. And so you kind of want to bank some extra for next year. But ultimately, our job is to be as honest and faithful as we can be with these numbers that we're releasing to stakeholders. So we should not manipulate. However, there are lots and lots of cases where you have seen companies manipulating this, and it's usually one of two things or both. One, so they can reach their earnings target and make their bonuses. And then two, so that when they release their earnings call to the public, it doesn't make their stock price sink if they've done worse than what they've told people they think it's going to make. So last thing, I want you to take the time to write down the differences and show on which financial statements net revenue, net receivables, and net income would show up on. And that is all just to get you to our starting point of what we will do in this chapter for intermediate.